Hi, everyone. Thank you for joining today's office hours on Fed Watch, Watching and Waiting, where you'll hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, Head of Fixed Income Strategy.
Well, Professor, always great to talk to you when we've got some green, on the screen. The markets liked a little bit what they heard today. The Fed's been yesterday. We've been saying the Fed is for yesterday's story, a lot on administration policies. I'm curious to get your take on that as well. But react to what you heard from Powell, your outlook on inflation, how it's impacting your view of the world today.
Yeah. Okay. So, normally you look at that and say, okay, growth was marked down, from 2.1 to 1.7, the biggest decline since the pandemic, extremely unusual outside of an external event or a recession. Inflation is marked up from 2.5 to 2.8. I mean, you could say, hey, that's the worst possible scenario. And actually, that scenario is one of the reasons the market's down 10% from where it was in December when the last quarterly Fed meeting was held. But basically, when I listened closely to Powell and looked deep on the clues, I could see why the stock market reacted favorably. One of the big questions was, in my mind, would the Fed react, delay the easing or even tighten rates as a result of the sharp rise in short-term and in some surveys, long-term inflationary expectations. And although he didn't rule it out because Powell never ruled anything out 100%, he basically said no. He said, I believe that is temporary. Immediately, one of the reporters stood up and said, well, I heard temporary 5 years ago. That didn't work out very well, did it? He said, sort of giggled and said, this is a completely different situation. It certainly is. It does mimic in the sense that it could be considered a supply shock, but it is a very, very different situation, implying that, and by the way, he pointed out the tariffs in 2019 were not inflationary. That also sort of bolstered his statement that if I see a rise in prices due only to tariffs, that would not induce me in and of itself to raise rates or slow down lowering rates unless I see it get into inflationary expectations in the financial data. He mentioned the famous five-year, which I'm sure that 90% of the people had no idea what he was talking about. The 5-year forward rate 5 years from now has been used by the Fed for about 20 or 30 years as a long-term inflationary expectation, taking the difference between five-year forwards and on the nominal and the tips. And he said that has not moved. Now, there's little more discussion on that, but basically he's right. Take a look at the tips, take a look at the difference. There's been very little long run movement, even though there's been a 1 year movement. And he said, I'm not inclined to move against that. So that's statement number one. Statement number two, he says we're very flexible. And we can, react, either way, depending on circumstances. Thought he was well positioned, didn't think he was out of position, like we're, way too tight or way too loose. And he also, and I think this also encouraged the market, he tended to, I would say, downplay the dramatic drop in consumer sentiment. He said we're not seeing it in the real data. And that is true. Not seeing it in the real data. He didn't rule out that it could be later, but as of now, we're not seeing it. And we talked about looking at jobless claims, that we don't see it at all. Of course, there's another one tomorrow. He also downplayed, he said, he talked about the Doge, the releases there. He said, although significant to the people who are being laid off, it isn't a big number and is not really impacting the big numbers here. He also deflected another question about whether if he could be dismissed by Trump, pointing to Trump's dismissal of the one of the commissioners of the FTC, and he didn't go there. He said, "I've talked about where I stood," and he didn't even repeat that answer. He didn't want to elaborate it. That's good news. He said he is not interested in getting into any fight with Trump about anything now. So, there'll be no friction. Now, I did say that, if the economy really slows, I can picture Trump saying, "Hey, come on, Jay, lower rates." And he's saying, "Well, I don't, the inflation is the other mandate, and that's not going on down, and I'm not going to do it as fast as you want, and there could be friction." But that ain't anywhere near yet. I also found it interesting that that nobody, not he nor any of the reporters, mentioned the date April 2nd, which we all know is the date when Trump is supposed to talk about reciprocal tariffs. Now, Trump could delay it and et cetera, but that's an extremely significant date. And it's only 2 weeks, I think, from today or close to it. So that the Fed will know an awful lot more. We will know an awful lot, hopefully. Now, they could be so vague that maybe we don't know more. But they could be pretty specific, and it might give comfort to the market. I mean, I'd say the market hates the uncertainty. The on-again, off-again tariff impositions of Trump over the last month and a half have been extremely detrimental to not only, I think, consumer sentiment, but also to investor sentiment. And as I've stated before, has been a major reason for the decline in of 10% in the stock market. If we get clarity there, if they look like they're measured rather than random and inviting all sorts of retaliation, we could see a nice rally. I'm hoping that the fact that in the last 4 or 5 days we've had the least up and down tariff announcements, I think, in a month, that maybe some of the advisors to Trump have basically said, let's cool the talk until we get what April 2nd comes to. And the market will welcome that. I can't promise that Trump will abide by that, nor do I even guarantee he's been told that. But yeah, he has kept his mouth shut about tariffs over the last week, which is the longest period for quite a long time. He hasn't talked about it. So, we're waiting for that April 2nd date. I think that that'll bring an awful lot of clarity to the situation. But however, let's not minimize the damage to investor sentiment that has been done. And I think there has been a lot of it. And it's slow to build back. Even, let's say, even if the Canadian tariffs turn out to be measured, I think the Canadians who decided I'm not buying, American liquor are not going to start buying American liquor again soon. It's going to take a while for that to wear off. So there's these sort of shocks to the system don't just immediately go away. They feed through sentiment and they feed through spending of the consumers. And so this will have longer lasting effect. We should also mention, as I did on CNBC and commenting that, the decline from 2.1% growth this year due to that was projected in December to 1.7. I mean, some of that is clearly this, what's going on this quarter. We think this quarter looks like 1 to 1.5 No, the Fed, the Atlantic Fed is just way, way too low. But that's still a point below. Now a point, over 4 quarters, well, one point in 1 quarter, no effect in 2, 3, 4 would only be 0.2%. This is a 0.4. So there is some lingering effect. But there's also another effect here. I mean, there has been a dramatic slowdown in, migration, illegal migration. And that's going to slow down real growth. It's also going to keep the unemployment rate from going up, even though growth slows down from 2.1 to 2.7. And in fact, the Fed only tips up this year by 0.1%, despite this, record go down in growth, because the supply of workers through the immigration stream is so much lower. And they next year they keep the same 4.3%, and to 2027 they keep the same 4.3%. Now they do slow down growth. In 2026, 2.0 to 1.8, and 2027, 1.9 to 1.8. They keep the 1.8 as the long term. That's not affected. I guess they don't trust that AI is going to have much of an effect on GDP in the long run. It certainly doesn't look like any sort of boost there. I was a little surprised that they didn't tick up the longer run Fed funds rate. I thought for sure it'd go up from 3.0 to 3.1. If you actually look at the details, there is a little nudge upward, but not enough to get up to 3.1. On what's called the natural or neutral rate, R star, on the Fed. One should also say, again, every year, including the long run, if you look at the details, has higher dots on average than in December. I mean, take a look at how many, and in fact, that was mentioned right away. The number of people that are less than 2 declines is much more than it was in December. And even if you go into 2026 and 2027, it's lower. And even the long run, as I said, was lower, even though it didn't make the rounding cutoff. So in a way, if you just kind of looked at some of these things without knowing the context, you would say, oh, my God, what happened? This is terrible compared to December. And the answer is this is not good relative to December, and that's the reason the market's down 10%. So the market sort of discounted this and hopes it doesn't get worse with a measured reciprocal tariff belief in April.
Professor, I wanted to ask you a question. In the headlines now, especially with just what you said, Fed dialing down growth, dialing up inflation. So you're hearing stagflation, stagnation again. So I was hoping, could you give everybody watching here just a little bit of a historical perspective of what 1970 stagflation was? Because Powell kind of alluded to that as well. And do you see that as a base case scenario, or do you see a recession?
Well, first of all, I don't see a recession. I can't say that a crazy tariff war wouldn't bring that about, but it's hopeful that is not going to happen. We are nowhere near the 70s, where inflation was 8-10% per year every year, and unemployment was 6-7-8%. I mean, we have unemployment of 4.1, and we have inflation of 2.5. Okay, remaining at now 2.8 core, 2.7 PCE. I mean, this is less than 100 basis points from long-term target. So we're nowhere near that, and I have no expectation we're getting anywhere towards the 70s. I pointed out many, many times over the last 5 years, the 70s saw the Fed pumping up the money supply at 10% a year, year after year after year, trying to counteract the contractionary effect of the Arab oil embargoes and other restrictive things, only to feed the inflation. The Fed is not increasing the money supply at a too rapid rate anymore. I mean, that was the 2022 episode. That's not the episode now. In fact, as I pointed out, I've seen a little softness in the money supply, and I think next Tuesday so if it's the last Tuesday of the month, it might be, we will get a money supply figure, but it definitely the money supply from December to January was one of the slowest increases we had in over 2 years. I wouldn't like to see that slow down dramatically, but we don't have the money to produce that sort of inflation.
Professor, we get a lot of questions about the equity response to everything going on. You got this rotation, both Mag 7 to everything else, as well as U.S. to Europe. Europe leading the way. Some of the same themes, but also just different policies coming out of Europe. How are you thinking about both of those, or the Mag 7 underperformance, and what do you think about Europe's leadership so far?
Yeah, I mean, I do think that I do think the line has been broken. That decisive upward trend that we talked about, I said it was broken 2 weeks ago, and it does. I mean, we got maybe a little brown sprack of growth value today, very minor, but it seems to the rotation still seems to be there. As far as Europe, we commented on that was a 14-15 PE ratio, and you didn't need, when you get that low, you don't need much growth to say this is where I want to be. I mean, even a 15 PE ratio with no growth is a 6 2/3 real return. So if you're going to get growth by the shift to a more aggressive military stance, Germany in particular, that is positive. I think that trade has a place to go. And I think as people rotate out, it has a place to go. And with bonds, now, I see the bond at 424. I said I thought the bond rate would stay 450 and above. I think the bond rate is still worried about recession, and that's, or a slowdown. Certainly not out of the question. It's a 10-year bond, so as a result, 1 year of inflation has very little. If you mark up your inflation as the Fed did by 30 basis points from December, I mean, assume it's 50 or 60 basis points. If over 10 years, that's only 6 basis points per year on the 10 years. So if you think that for 1 year we're going to have 0.6 more, and that's double the Fed, you'd only raise the 10-year by 6 basis points for a given real rate of interest on the bond. Now, of course, if it sparks an inflationary type of spiral, it starts infecting other prices, and the Fed supplies enough money to keep that, show running, that's a different story. But, a 1 year increase in prices, even a 1 year increase in prices of, 1 full percentage points is only 10 basis points on the 10 year. So, you basically got to take that into account. Their inflation projections basically for 2026 are unchanged. I think they have 1/10 more on overall PC inflation, but the core they say is unchanged. So
Professor, we had a dissenter, Governor Waller.
Yeah, and it was the first dissent on QT I've ever heard of. I think it never has there ever been. I guess he said, I don't want to slow down the, reduction. Now, this was one interesting thing. And I would have asked. He mentioned twice that he saw a little hints or rumblings in the money market.
Yeah.
But he never mentioned what they were. I was going to say, okay, show us where. I haven't seen it. He's seen it. What has he seen it in? I thought that would have been interesting as a clue, but no one asked him. I don't know why. I would have. He mentioned it twice. Okay, you're saying you're seeing a little bit of disturbance in the money markets. That's why you're slow. One reason why you're slowing it down. What are those disturbances? Nothing. Maybe he will elaborate that later on. I mean, I don't think they're serious. I'm not saying that, this is the canary in the coal mine, that, oh my God, this is the beginning of a financial crisis, or even anything like what happened in 2018, where they were doing quantitative tightening much faster, and it hit them like a brick stone. All of a sudden, the bank said, "Oh wow, you're taking away too fast, and we need those reserves." So that's why he kept on talking about the glide landing. We're aware of what happened then, and we're just slowing it down. But I would like to have known what rumblings in the credit markets he was referring to.
Professor, maybe because we've done such a good job giving the equity worldview and some of the bond outlook, we're getting a number of people writing in on commodities and gold. A few people wrote in on that. Gold making new highs. Commodities.
Yeah, let's see. Was gold again up today? Yeah, I see. What? Yeah, 0.38%, 3,046. The commodity index. Well, it is interesting. Powell mentioned that goods prices were up pretty much, and we don't know how much is that advanced buying on the tariff side. You see, all that tariff talk has distorted an awful lot of stuff. And, we have seen commodity prices firm, but again, there is no hyperinflation, and 1 year inflation of, rise of 50, even 100 basis points, to me, does not start arguing that. I'm not saying the momentum in commodities can't continue, but it does not, seem to be, to me, something that suddenly argues for those commodities. That trend is there, and we know trends follow a long time. And if you're skillful as a trend follower, this could be a play. Just like if you were skillful at AI until it broke its trend about 2.5 or 3 weeks ago, that was a great play. I mean, it turns out that, momentum plays skillfully handled can be powerful. But as something to hedge against hyperinflation or some big rise of inflation, I just don't see other indicators that say that is what we see.
Yeah, the other thing I wanted to ask you that you read about quite a bit lately with the cuts in federal government, whether it's Doge related, whatever, that it will spill out into the private sector. Are you concerned about that? If you are, how much, or do you think that's overblown?
Well, there's a couple of things. I mean, first of all, the whole question of job security does affect consumer sentiment and spending. I've talked about that, I think, in the last podcast. So if someone, who thought his job or her job was totally secure now thinks there's a 20% chance it's going to be cut, will cut back on their spending. And that's not irrational. I better wait a year before buying that new car. I thought I'd do it this year, but hey, if I don't have a job, that's going to be difficult. So that job security is one issue. Now spilling, and that could affect spending, that affects obviously the economy. The other issue, of course, is are firms going to start doing cost cutting? They should always be doing it if they want to remain competitive. Don't forget, private firms don't really have, They could be more efficient, to be sure. Everyone could be, but they don't have the basic structural inefficiency problems that either governments or the nonprofit sector has, because there's always competition that'll force efficiency in that. And that's good. Efficiency raises productivity. Listen, some of these people released from government should find productive jobs in the private sector. I mean, the job market is not bad. Unemployment, it's 4.1% is still considered to be quite low. I mean, it isn't red hot like it was, a year or two ago. But it's happened to be better. I mean, in some cases, it could be the type of jobs, but with the slowdown in immigration, there's going to be some tightness on some of those labor markets in some of those areas. That could be wage inducing and be slightly inflationary, depending on circumstances. But a lot of the people released from unproductive government jobs will actually be positive to the economy by finding productive private sector jobs. We want to encourage the private sector. And to the extent that that's done, that's positive.
So, Professor, if you said your risk to the 10-year is 3.5 on recession view or 5 on growth view, which way?
Well, now that it tends to be down, and the 5, the 5 seems further away certainly than it did 3 or 4 months ago. But don't forget, we still have the budget, the deficit. The budget, all the questions of the budget have sort of been pushed aside, temporarily because of this tariff thing. The Fed announced, we know that this budget question is going to come to the fore again. And a lot of, the question is how, we still have a $2 trillion deficit. And, how big will it be in the next coming years, and how easily will it be absorbed? It's going to be a real question. Also, if real growth comes back, if the tariffs are reasonable and people's sentiment goes up again, you're going to see that long bond go up. Real growth is a very, very important factor. Probability of recession. I see this decline probability of recession gone up. If that probability of recession goes down with reasonable tariffs on April 2nd, I think the bonds are going to retrace their yield.
Very good. And now that we've had our correction on the S&P, you're watching tariffs as the number one indicator. That's our
I'm watching April 2nd. I really am, and seeing whether that's measured and give us clarity, and whether Trump can wait 2 weeks before talking about tariffs again, and his study group come up with some proposals that people can, hang their hats on.
Well, very good. We appreciate always getting your comments on a Fed day. It's great to be with you. For people who want to follow along, we do Behind the Markets, our podcast every week. The professor gets a commentary from that. If you want to follow along, your advisor, want to follow along our models and how we're thinking about the world, you can find our Professor Siegel-oriented models on many different platforms. So check it out there as well. Kevin, it's always great to be with you. Irene, thanks for hosting. We'll see people again next time.